Did you know that over 60% of people miss out on the opportunity to grow their wealth simply because they don't invest? The truth is, not investing could be costing you thousands, if not more, over time. In this video, I'm going to walk you through the 7 essential steps you need to build your first investment portfolio. It doesn't matter if you are starting with 100 or 100,000. This guide will give you everything you need to begin investing with confidence and avoid the most common mistakes beginners make. Stick around, because by the end you will know exactly what to do to get your money working for you today. I'm Dominic, and for the past 9 years I've been investing in stocks, ETFs and building long-term wealth with an average return of 15% annually. My goal is to make investing simple, accessible and most importantly, something you can start right now. Whether your goal is financial freedom, early retirement or simply growing your savings, this guide is perfect for beginners and will help you avoid the common traps that hold most people back. Why most people don't invest? Let's be real. Investing can be scary and a lot of people feel completely overwhelmed by it. Maybe you felt this way yourself. You don't know where to start and you've heard horror stories about people losing all their money in the stock market. This fear causes people to miss out on years of potential growth. The truth is, investing isn't as complicated as it seems. With a solid plan and the right approach, you can reduce your risk and build wealth steadily over time. If you are not investing, inflation is eating away at your savings and you are leaving money on the table. But don't worry, after this video, you will have a clear strategy to get started. Did you know that if you start investing 200 a month at 25, you could have almost double what you would have if you started at 35, even if you contributed the same amount over time? That's the power of compounding. Step 1. Set your financial goals. The first step is simple, but it's one that too many people overlook. Setting clear financial goals. Why are you investing? Is for retirement, to save for a house, or to achieve financial independence? Setting specific goals will keep you focused and help guide your investment strategy. For example, if your goal is to retire in 30 years, your portfolio might look different than someone who's saving for a short-term goal like a wedding in 5 years. Take a moment to write down your financial goals and set timelines for when you would like to achieve them. This step helps you stay disciplined and avoid impulsive decisions. When I first started investing, my goal was simply to grow my savings for the long term. But over time, I refined that goal. I wanted to build enough passive income to retire early. That's why it's important to revisit your goals as your life changes. Step number 2. Assess your risk tolerance. The next crucial step is assessing your risk tolerance. This simply means figuring out how comfortable you are with the ups and downs of the market. Some people can handle watching their portfolio dip 10% and still sleep well at night, like me, while others might panic and sell at the first sign of trouble. To determine your risk tolerance, think about your emotional response to risk and your financial ability to handle losses. For example, if the stock market dropped by 20% tomorrow, what would you do? Would you see it as an opportunity to buy more, or would you want to sell everything? The key is to match your risk tolerance with your financial goals. In 2020, the stock market saw one of its biggest drops in history, but the people who held on and kept investing through it came out stronger. Understanding your risk tolerance ahead of a time helps you avoid panic selling during moments like this. Step 3. Building an emergency fund. Before you put any money into the stock market, it's essential to build an emergency fund. This is one of the biggest mistakes people make. They start investing without any safety net, and when life throws them a curveball, like a car repair or medical bill, they are forced to sell their investments, often at a loss. Ideally, you want 3 to 6 months of living expenses saved in a high-yield savings account. This fund is there to cover emergencies and prevent you from having to touch your investments when you need cash fast. I remember when my car broke down unexpectedly a few years ago. Thanks to my emergency fund, I didn't have to touch my investments to cover the repair, and my portfolio stayed intact. Trust me, having that cash cushion is a lifesaver. Step 4. Diversify your investments. Once you are ready to invest, the key to long-term success is diversification. This is one of the most important concepts in investing. Don't put all your eggs in one basket. Diversification means spreading your investments across different asset classes like stocks, bonds, real estate, and alternative assets like crypto. This helps protect you from major losses because when one area of your portfolio is down, other might be up. For example, if the stock market is struggling, your bond investments or real estate holdings might provide stability. Diversification reduces risk while still allowing for growth. Think of a diversification like building a soccer team. You wouldn't want 11 goalkeepers, right? You need a mix of positions: strikers, midfielders, defenders. The same goes for your portfolio: stocks, bonds, real estate, and maybe even some crypto for the more adventurous. Step 5. Choose the right investment account. Now that you understand diversification, it's time to talk about investment accounts. This part can be confusing, but I'm going to break it down simply. There are two main types of accounts you will use: retirement accounts like IRAs or 401ks, and taxable brokerage accounts. Retirement accounts come with a tax advantage, like tax-free growth or tax-deductible contributions, but there are restrictions on when you can withdraw your money. Taxable brokerage accounts, on the other hand, are more flexible and allow you to access your funds whenever you want. Knowing how to use both types of accounts is key to maximizing returns. I personally use a mix of both. It's all about finding the right balance for your goals. Step 6. Start with low-cost index funds and ETFs. If you are a beginner, one of the best places to start is with a low-cost index funds and ETFs. These funds gives you exposure to a wide variety of stocks or bonds, providing instant diversification at a low cost. Instead of trying to pick individual stocks, which can be risky and time-consuming, index funds allow you to invest in the entire market. For example, you can buy an S&P 500 index fund that gives you a piece of the top 500 companies in the US. This is a great way to grow your wealth steadily without worrying about constantly monitoring the market. Let's say you invest in a mutual fund with a 1.5% fee versus an index fund with a 0.04% fee. Over 30 years, that small difference in fees could cost you tens of thousands of dollars in lost returns. Step 7. Stay consistent and be patient. The final step is to stay consistent and be patient. One of the biggest challenges for new investors is staying the course during market volatility. It's tempting to try to time the market or pull out when things get rough. But remember, investing is a marathon, not a sprint. The most successful investors are those who stay invested over long term, through the ups and downs. Set up automatic contributions to your investments accounts, stay disciplined, and let compounding work its magic. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." If you stay invested and keep contributing, your wealth will grow over time. If there's one thing I want you to take away from this video, is that anyone can start investing and build wealth. The key is to diversify your portfolio and stay consistent over the long term. Whether you are starting small or have more to invest, these 7 steps will set you up for success. Alright, let's quickly recap the 7 essential steps for building your first investment portfolio. 1. Set clear financial goals. 2. Assess your risk tolerance. 3. Build an emergency fund. 4. Diversify your investments. 5. Choose the right accounts. 6. Start with low-cost index funds and ETFs. And 7. Stay consistent and be patient. Remember, anyone can start investing. It's not just for the wealthy or the experts. With the right approach, you can take control of your financial future and build lasting wealth. If you found this video helpful, give it a thumbs up and share it with someone who's just getting started with investing. What are your financial goals? Let me know in the comments. And if you haven't already subscribed to the channel for more videos on how to make your money work for you, thanks for watching, and I will see you in the next one.